If you listen to most of the financial YouTubers or gurus, everybody is saying now that Uber Technologies is a massive generational wealth opportunity and you should buy it because it's extremely undervalued. So we're seeing all those people being so confident about Uber future. I'm doing a video to say why I am not buying this stock, and I will try to be the less biased possible. I will show you the good thing about this company, but also the bad things that make me think that it's not a buying opportunities, at least for me and for my portfolio. Something we need to precise before analyzing this stock, checking the values, the numbers, and so on, is that my goal with my portfolio is to beat the market on long term. So keep this in mind, because it's not because I think Uber is maybe not an opportunity for me that it cannot be for somebody else. So I will show you exactly my analysis on this stock and the reason I'm not buying. So first thing, we need to look at the numbers, and the numbers for Uber are pretty good, to be honest. They have 13% growth year over year and like more than 15% each year since few years on MAPC, which is the number of unique consumers who completed a mobility ride or received a delivery. You have a monthly trip, okay, 4% up year over year. So it was higher before, but still grows. And the global trip, the gross trip, 17% year over year, which is pretty good. When it comes to gross booking, is up 20%, okay, year over year. The revenue up 22%, adjusted EBITDA up 55%. So we have some pretty good number for this company. If we go to financials, we can check at the total revenue. It's a good growth, okay, 36% growth annually since the last 10 years, which is very good growth. We can check the net income. The net income, it became profitable a few years ago, last year in 2023. Now it keep growing, it doubled year over year, while it was not profitable before. So it's profitable since a year, 2 years. So this is a good news for shareholders. You can check as well at the number of shares outstanding, okay, growing. The number of shares outstanding is actually one of the reasons why I am not buying, because we have dilution, but it's normal for a young company, it can be normal. But I have some things that are scaring me a bit for the future about this, but we'll go after. Now we check the numbers and the reason why it can be a good opportunity. If you check as well as the free cash flow of the company, they have a good free cash flow. Like since 2002, it's growing, and it's really growing fast. Like if you put it here, since it's profitable, it's growing 374% per year, and it expects to continue to grow in the future, like pretty good. If you put last 12 months, it's supposed to grow 25% per year. Like the long-term growth for this company is expected to be 37%, 38% per year almost for the earning per share on long-term growth, and 63% for the forward 2 years. So it's very good. The price now is around $68, so it's a good price for now. The PE ratio is almost 34. The future P ratio, the next like forward P ratio is 32, and the price to free cash flow 24, and the forward price to free cash flow 20. So 20 forward price to free cash flow for companies that seem to have some good quality can be nice. When it comes to debt now, which is important to check, we'll go in ratio. We want financial health. We'll take debt on EBITDA on EBIT on interest expense. Even if it's profitable, I find it a bit low here, okay? I find it a bit low. The same, debt to equity, 80%. It's a bit, could be better. Not too bad because it's decreasing since 3 years, but could be better. And net debt to EBITDA, it's good. They have more cash than debt. So, they have more cash than debt. So net debt to EBITDA negative. It's pretty good. The only thing that trigger me a bit is this EBIT on interest expense, which is not really good yet, but with the growth that they have, it should be fine in next years. When it comes to numbers, there is one thing that I don't really like about this company, other than share outstanding. It's in the cash flow statement, it's the stock-based compensation. When you compare this to free cash flow, you have a stock-based compensation, which is huge. So here, 1.846 compared to 5 0.957. It's pretty big. It's almost 30% of stock-based compensation. And before it was almost 50% of stock-based compensation, which is way, way, way too high. We like it under 10%. And when we see that the CEO doesn't have a lot of shares, that's for me like, it's not a red flag, but it's not really good. It's not something that I really like to see in a company. When it's come to value now, we have a free cash flow of 5,957. Number of shares outstanding 2,104. So it's pretty good. Okay, it's fine. Let's imagine that we'll continue to have some dilution of 2% per year, and with a growth rate of 19%, we could have 13% return with the company. So to be honest, to be fair, I think the valuation is pretty good. Like if we like 20% growth rate for the company for the next 5 years seems pretty fair and seems possible. Okay, and here it's with a PE of 20, a price to free cash flow of 20. If we put price to free cash flow at 25, it gives even better. So a 20 price to free cash flow for companies that go 20% a year, it's really low. Okay, so I mean it's not really low, but it's very good, and it's apparently likely to happen. So when it comes to valuation, I feel the valuation is good. You can have some good return with the company if you buy at this price, if you buy at $67, $68. Like if you buy around this price, you can have something pretty good. But why, with all of this, I'm still not buying this stock, and I still don't consider it as an opportunity for my portfolio? So the first thing is stock-based compensation is too high, 30%, 50%. Even if it should decrease in the next year, I find it way too high, under 10%. So if it was 15%, I would say, okay, why not? With the growth that we'll have next, it should be okay. But here, 30% is pretty good. The second thing is the company doesn't have a wide moat. The company have, from Morningstar, fundamentals, the Morningstar moat is narrow and stable. Stable means that it's not growing. Eventually, I would like a narrow moat with a growing trend of the moat, but here is narrow. And I don't really understand why a company which is almost like, it's almost a monopoly, okay? Especially if you check at the if you check in investor relation at the presentation here, we'll go to slides, you will see they own shares in most of their competitors. We'll go down. They own share in DD, Grab, so they don't have share in Bolt or Lyft, but they have share in plenty other companies, especially in Grab, which is really developed in Asia. So why they don't have a trend which is growing and a moat which is higher, while they almost have a monopoly? Okay, they get most of the market. Of course, you have also Lyft in the United States, but Uber have most of the market, and still yet they have just a narrow moat. The reason why people are afraid, it's because of automatic vehicle. Okay, you will have maybe some Tesla Robotaxi automatic vehicle that put Uber in a situation where maybe people will not use Uber anymore. They will use Tesla, they will use Google or whatever to have this. I don't think this will be bad for the business. I think it will be a good point to grow margins. But the thing is, they will need to create a float of those Uber cars. So for a moment, maybe they will not be profitable to create those floats, or even worse, and it's the thing that afraid me, that I think may happen, is they will again dilute the shareholders. They had done it already in 2019, okay? Like they 3x the number of shares outstanding. And I think they may again do a dilution, not do buybacks for the shareholders, to finance those Robotaxi cars, to finance those automatic vehicles. So that's the things that make me think that it can be problematic. Other thing is the CEO doesn't have a lot of share, but it's normal because he is not the founder. Okay, he have less than 0.1% of share. He is not the founder, so it's kind of normal, but the founder have sold 90% of their share while at the moment it went public. Like they sold everything, they get out totally. Other reason why I'm not buying this stock is because it's too new, in the sense that, okay, it's a company that was founded in 2009, sorry, but it's profitable only since 2023. The free cash flow is positive only since 2022. It's a bit too young, especially with the investments they will need to make next year for those automatic vehicles. So for me, the company is a bit too young. I'm not saying I will never buy Uber. I'm just saying that for now, I would prefer to wait before buying, maybe in 5 years, maybe in 10 years, with some stronger income statement, some stronger balance sheet, some stronger cash flow statement. I will buy. If we have like 5 years or 10 years of good growth, here maybe I will start buying the stock, because it will be easier to value and it will be easier to determine if they have really a good competitive advantage. There is something very important to know when you want to beat the market on the long run, is you don't have a lot of bullet in your gun. So you need to pick carefully the opportunities that you will seize. And for me, Uber for now is not an opportunity that I want to seize. Yes, the valuation is good, but yet is not a great opportunity for me, for my portfolio, with my vision and with the type of company I'm looking for. Yes, it has the potential to be a very good quality business, but I prefer a business which is already great quality, which have already great numbers, and then try to find a good entry point, than finding the next great quality business for the future, because I find it like too difficult. And if you look at the number, you have way more chances to not manage to have a good one than to have a good one. Last thing is about super investors, okay? While Uber is such a bargain when you check at all the YouTubers online and everything, but yet you don't have a lot of super investors or fund managers that have more than $100 million asset under management. You don't have a lot that invest in the company, and moreover, you don't have a lot that really trust fully the companies that put more 3% of their portfolio. The one which is has the biggest percentage of his portfolio is Thomas Russo with 3% of his portfolio. On Uber, you have John Armitage 2.5%, William von Muffling 1.8%, and David Tepper, that I really like to follow, 1.57%, and he's reducing. So there is not big investors that have a big conviction on this company. And for a company that it's such a good deal, that is such an undervalued company, I find it kind of strange why everybody is not buying more, especially big fund manager, and especially fund manager that have outperformed the market for the last 5 years, 10 years, 20 years. Why they are not buying if it's such a good opportunity, as you can see on the internet. So that's all for my analysis on this stock, why I don't buy Uber stock. Let me know if you have in your portfolio. Again, I want to be sure that you understand that it's not a bad company, it's not a bad business to buy. It's just why I decide to not buy. I think it's important to hear the bear case on this stock, the reason not to buy. I don't think this stock will totally plunge. I just not very confident that it will beat the market for the next 5 to 10 years. Maybe in 5 years it will be an opportunity to beat the market with, but for now I'm not sure about it and have so little bullets in my gun that I don't want to waste one on this. Maybe in the future it will be good, and if in the future it will be good, maybe the one that was believing now that it's a good opportunity will get very rich. But for now, it's not a company that interests me at the moment because it's way too young. The net income are positive since only 2023, so I want to wait at least 5 years to have more history of positive net income and growth.